Hello, scholars. Welcome to Chapter 2 in Corporate Finance. I'm your professor, Chauncey Joyce. Let's take a look at our learning objectives. We're going to find out the difference between accounting values or book values and market value, the difference between accounting income and cash flow, the difference between average and marginal tax rates, and lastly, how to determine a firm's cash flow from its financial statements. So in this unit, we're going to look at the balance sheet. We're going to look at an income statement. We're going to understand taxes, free cash flow, also called cash flow from assets, and then we're going to wrap up with this statement of cash flows. So why do we use financial statements? Let's hear from Warren Buffett himself. Managers and investors alike must understand that accounting numbers are the beginning, not the end of business valuation. So here's a list of reasons why we use financial statements. Well, publicly listed companies are required to publish financial statements. We use financial statements to aid in decision making. We use financial statements to estimate and calculate relevant cash flow assumptions for valuation. That's very important for finance. And a familiarity and understanding of financial statements is an essential skill for business leaders across all divisions. Oftentimes, you're rewarded or measured on certain metrics that are accounting based. And understanding how the financial statements interact with each other is another essential skill. That's a pretty difficult one to do, so you need some practice at these financial statements. It's nice to look at SEC filings, Securities and Exchange Commission filings. Publicly traded companies in the United States are required here to publish an annual filing called a 10K. So a 10K has a lot of useful information that we use in finance. If you can't find your firm's 10K, maybe you're looking at Toyota or something. The reason is they have a 20F. They're a foreign company listed on a US exchange, but a lot of similar features will be in the 20F as there are in a 10K. So let's take a look at a balance sheet. There's quite a bit to process here. First, let's start at the top. We have the title of the company, U.S. corporation. We have the dates. So we have two different dates. A balance sheet is a snapshot in time of all of the assets, liabilities, and equity for a firm. So the last period is in one column. So all of these figures are represented in 2011. And then this column is also 2011, whereas the current period, which is 2012, is in this column. So it's just a snapshot. Sometimes you see this called the beginning period, and then this would just be the ending period. So you could just see some kind of change in cash or change in accounts receivable, change in inventory, etc. One thing to notice is you have your assets on your left-hand side and your liabilities and your equity on the right-hand side. So if you have assets, that's here. Assets are equal to your liabilities and your owner's equity. It's important that these balance. That's why we call it the balance sheet. So think of your assets as the use of funds and think of the liabilities and the equity as the source of funds. How did you get those? Did you take out a loan or issue a bond, or did the owner give you money to contribute to the business? Or did you use past profit? So past profit is called retained earnings. Cash, this is just think of this as what would be in a checking account. Accounts receivable, those are current assets. You had a sale to a customer, they didn't pay you cash yet, so you expect to receive those. Inventory, that's what you have on hand before you make a sale if it's selling a product. All of those are considered current assets and they're listed by liquidity. So cash is your most liquid asset, followed by accounts receivable and then inventory. Liquidity has two components. It's the ease in which you can convert an asset into cash. That's the first one. And the second is without loss of value, without significant loss in value. So you have your current assets. You also have your fixed assets. Think of these as long-term assets. Your manufacturing plants, your property, your equipment, your land, your goodwill, and patents. So current assets, we can split assets in terms of current and fixed assets. So think of this as long-term assets, or also called fixed assets. Then on your liabilities, you have current liabilities, accounts payable. Maybe you were selling a product and you haven't yet paid your supplier yet for that, you still owe it. That's an account payable. Notes payable, that's due within a current year or operating cycle. And then long-term debt, perhaps you issued a bond and now you have long-term debt. Owner's equity, this could be common stock and paid in surplus. That's the owner's historical record of what they have contributed or invested into the company. Retained earnings, that's an important one. The retained earnings are just a record of all the profit the company has kept. So notice an important feature here with the balance sheet is that it does balance your 2011 assets balance with your 2011 liabilities and equity. And the same thing you see with 2012. Your 2012 assets balance with your 2012 liabilities and equity. It's called a snapshot because the balance sheet is at a point in time, a specific date and time. Net working capital is an interesting measure. It's your current assets less your current liabilities. It's positive when cash that will be available over the next 12 months is greater than the cash that must be paid over the next 12 months. So that's an important one to try to keep positive. Flourish and Blotz has total assets of 4,900, fixed assets of 3,200, long-term debt of 2,900, and short-term debt of 1,400. What is the amount of net working capital? So let's try to do this. We have total assets, and we can dissect total assets into current assets and fixed assets. So if we have total assets here of 4,900, we're going to put that on the left-hand side, and we're searching for current assets. We know fixed assets are 3,200, so the only missing variable are current assets. So we're going to subtract the 3,200 from each side, and then we'll get to current assets equals 4,900 less 3,200 is 1,700. So we're going to use that 1,700 when we're going to set up our next identity, which is net working capital equals current assets less current liabilities. So we're going to pull in this current asset piece and subtract our short-term debt, also called our current liabilities, of 1,400 and get our net working capital of 300. So that was interesting. We had to use a couple different identities there. The first was that total assets is the sum of current assets and fixed assets. Remember, the other way you could get to total assets is adding your total liabilities and your total owner's equity. We didn't need that in this case because we were searching for current assets. Let's take a look at the next one. This company has shareholders' equity of 141,800. The firm owes, that's a liability, a total of $126,000, of which 60% is payable within the year. The firm has net fixed assets of 161,900. What is the amount of net working capital? Now, before we can solve for net working capital, we're going to need another identity first. Take a second to see if you can figure out what that would be. We need assets equal liabilities plus owner's equity. So we're going to search for assets. We have liability, that's what we owe a total of 126,000. And we have owner's equity of 141,800. So we have total assets of $267,800 assets. We have also given, we could use the 60% to find current liabilities. We have net fixed assets or long-term assets, it's 161. So actually that's what we'll do next. We're gonna use the next identity, and that's that assets equal current assets. I'll just put CA for current assets, plus I'll put net fixed assets or NFA there. So our total assets will pull the number we just calculated, 267,800 equals your current assets plus the net fixed assets, which was given in the question of 161,900. That means your current assets are going to equal the 267,800 less your net fixed assets of 161,900. So your current assets are going to be 105,900. So we're still looking for net working capital. We're almost there. Our net working capital is going to equal our current assets less our current liabilities. So our net working capital in this case, we solved for our current assets already. We have 105,900 of those. Less our current liabilities, we have to calculate that the firm owes a total of 126,000, of which 60% is payable within the next year. So 60% of that number is current. So I'm just going to take 126,000 and multiply that by 60%. So we have 126,000 times 60%. So our total net working capital will come out to $30,300. That was a little tricky, required 3 different equations to use in this one. So that's a really good question to assess whether you understand all of these different pieces on the balance sheet. Those are 3 very important equations for us to use. Nicely done. That was challenging. Let's take a look at a real balance sheet. You just see a lot of the similar features. You have your assets, you have your liabilities and equity. Notice these things will balance. It's a balance sheet, so that's required. They should balance. If you remember from your accounting classes, all your debits and credits, your left-hand side, right-hand side stuff, your T accounts, then this should all work out clearly. In actuality, these look a little bit more complex, but what's nice about accounting is they're based on rules. And so you can understand those rules and work on them. And then with enough practice, you'll be able to look at this and read it and ask yourself some questions and know where to dig to find some of those answers. So they say accounting is the language of business, and that is for sure correct. Let's look at debt versus equity on the balance sheet. So we're going to focus on the right-hand side, also called the source of funding, where the money came from. Assets are your use of funding. Sometimes you see shareholders' equity rearranged like this as assets less liabilities. I like to show it that way because you can really see that it's the residual value. And think of it this way, is the owner can get what's left after all the debt has been paid. So the assets don't belong to the owner. We actually have to pay off the liabilities before the shareholders' equity or your owners can get paid. Debt, that's a creditor. This came from a creditor, usually a bondholder or a loan, like a bank, something like that. Debt, another word for debt is leverage or liability. Equity holders have residual value. Sometimes you hear it just called residual value, and it's known that that's identifying equity. And economically, this makes sense, like we just mentioned. If a firm sells everything and pays all the debt, the remaining cash would belong to the owners. So let's talk about this idea of financial leverage. Leverage is the use of debt in capital structure. So if you have assets equals liability and equity, if you are sourcing your assets with a lot of debt, we say you're using leverage. So maybe remember that is leverage for loan or liability. More debt will imply more financial leverage, and that will magnify your gains and losses, and you would see that impact on your income statement. Let's take a look at 2 different views here on how to view leverage. And this opinion from 1989 came from Warren Buffett. A small chance of distress or disgrace cannot, in our view, be offset by a large chance of extra returns. If your actions are sensible, you are certain to get good results. In most such cases, leverage just moves things along faster. Charlie Munger and I have never been in a big hurry. We enjoy the process far more than the proceeds, though we have learned to live with those also. And then we have, as Archimedes suggested, and as depicted on the cover of this book, give me a lever long enough and a fulcrum on which to place it, and I shall move the world. So companies do have this trade-off in terms of tax advantages from using debt because it will lower your taxable earnings versus the risk that debt imposes through this idea that gains are magnified. The firm becomes riskier. So how to think of this fulcrum idea is, well, this is the large asset the company is trying to move, and the equity is what the firm muscle is. It's what they bring to the table. And then the leverage or the liabilities is the stick they're using to help move those assets. So this is equity and then this is liabilities. All right, let's take a look. This is one of our learning objectives, is to identify the difference here between book value and market value. Book value under GAAP, generally accepted accounting principles, this is a historical cost that accountants use to record a transaction, whereas market value is what we in finance consider an asset truly worth. It's the value of an asset if it were sold in a marketplace, what we could get in terms of cash for it. And we like to use market value as more relevant for decision making. However, a lot of what we're looking at in some of these accounting statements is book value. So we have to keep that in mind when we're making decisions. So if you recall from chapter 1, we are concerning ourselves with decision making and firm value. So as much as possible, we need to use estimates of market value as opposed to just book value. Book value could lead us into an incorrect decision. Now we're going to move on to the income statement. An income statement measures a firm's performance over a period of time, usually quarterly or annually. And the equation we're going to use for the income statement is that revenues less expenses equals income or profit or net income or earnings. In finance, we concern ourselves with cash flow. We would like to just focus on cash flow. However, under GAAP, an accounting system, an accrual accounting system, we need to remember these two important principles. The first is the recognition principle, and that states that revenue is recognized at the time of sale, not necessarily the time of collection. So although they're recording a sale, in finance, we're saying like, hey, unless we got cash for that, we really want to see what the cash sale was as opposed. And then the matching principle says the production costs and other costs associated with the sale are recognized at the time of sale, not necessarily when cash was collected or received for that. So think of your accounts payable. As a result, the financial figures on an income statement are not representative of the actual cash flows that occurred during the period. So often in finance, we're going to take these income statements and we're going to have to make some adjustments for this cash factor, even though we have some elements listed on the income statement. If those aren't cash basis, we're going to have to make some adjustments because, again, in finance, we care about cash flow. And so we need to keep that in mind. Let's take a look at a very typical income statement. We have net sales or revenue at the top line. Then we deduct our cost of goods sold. We allocate our depreciation. That's the allocation of the cost of something like a manufacturing plant, property, equipment over time. If you deduct those, you get to what we call EBIT, or earnings before interest and taxes, EBIT. Then you deduct interest. That's the cost of borrowing. So that's going to go pay off the liabilities you have. Then you have taxable income. Then you pay Uncle Sam, if you will, or your government through taxes. Then you have net income or earnings or profit or bottom line. Net income can go one of two places. You could give it to the owner, and that distribution to the owner is called a dividend, or you can retain it and continue to grow internally. And we call that in addition to retained earnings. So this would be the amount added to retained earnings on the balance sheet. There are a couple non-cash items we see here, and the most important one is probably depreciation and amortization. Non-cash items are expenses charged against revenues that do not directly affect cash flow, like depreciation. But be careful with this. Depreciation does impact cash flow. While it may not do it directly, there is an indirect effect. Take a second to see if you can figure out how. Well, before we do, let me give you another hint. What is depreciation? That's the allocation of a cost over time of a long-term asset. Remember those fixed assets? Something like a manufacturing facility called a plant. And this plant, if we get a 20-year useful life out of it, accountants say we have to match the benefit that that plant gives us over time, but we just paid a one-time 20 million cash outflow for it. So we have to allocate that cost over time through depreciation. So we're going to have to match that cost of that one-time cash flow over a long period of time. So say 20 years. So if we have a 20 million cash outlay and we have to allocate it over 20 years, if you did that straight line, you take $20 million divided by 20 years, gives you $1 million in depreciation per year. That's consistent with this idea of the matching principle. We have to match these costs associated with the sale at the time of the sale. So this plant allows us to have sales for many years. So back to the question, depreciation does have an impact on cash flow because it lowers your EBIT, which lowers your taxable income, which will in turn lower your taxes. So it indirectly lowers your tax bill because it lowers your taxable income. This idea of allocating depreciation over time. So why don't we just list the entire cost of the asset? Well, that would be inconsistent with the accounting procedures. What happens to net income? It can go one of two places. It goes to the owner or it gets retained. So think of this as everybody else has been paid out of sales. Who hasn't been paid yet is yourself and the owner. So the owner gets paid through a dividend, the shareholder, or you retain it and continue to grow internally. Take a look at this. This is just a little bit more complicated of one for Apple. Sometimes you see certain elements included that weren't on a typical one, but it's easy enough to figure out what those are because, like I said, accounting is a very rules-based system, and we're all hopefully playing by the same rules and being consistent with how we treat everything. And again, if this is confusing at first, I understand that's normal. Accounting, I don't think, is a very intuitive subject. So I promise you, you'll get better with more practice. So the more of these you look at, and I would recommend if you really want to get good at this, start pulling some of this stuff, these 10Ks from your favorite company you can understand, look at it, see how the business works. And the more and more of these you do, the easier and easier this will become. And it's almost like reading a new language because it is the language of business. But right now it may look cryptic, may look confusing. It just means we need to spend more time and more practice on it, and we will get better. Let's take a look at taxes, average and marginal taxes, and then I'll show you how to read this table and how to compute those. So the average tax rate is your total taxes paid divided by your total taxable income. Your marginal tax rate is the amount on the next dollar earned. So this table really just tells you the marginal tax rates. So if your $0 through 50,000 is taxed at 15%, then your next 25,000 in this range is taxed at 25%, and then your next 25,000 is taxed at 34%. So let's take a look and see if we can calculate the average tax rate if our taxable income, let's make up a number here, is 80,000. So the way to do this is we have to first compute total taxes paid. So our total taxes paid, we have to take this first 50,000 taxed at 15%. And then our next 25,000, which is 75,000 minus 50,000, is going to be taxed at 25%. And then our next 5,000, which is somewhere in between here, is going to be taxed at 34%. So I'll put that 80,000. There we go. So we'll take 50,000 times 15%. I'm going to save that number just by pressing store 1. And then I'll take my next 25,000 times 25%, store that is store 2, and then take my next 5,000, whoops, backspace, times 34, and store that as 3, add recall 1, that first number, add recall 2, that second number we calculated. So our taxes paid should be 15,450. And so we'll just apply this definition. The average tax rate is your total taxes paid divided by your taxable income. So your average would be the 15,450 over your taxable income of 80,000. And you'll get to 1931%. So this, you have to calculate average tax rate by yourself, but the table will give you marginal tax rate. So the tax on the next dollar owned, the amount of tax payable on the next dollar earned, sorry, is in this range. So the marginal tax rate is actually 34% if your taxable income is 80, because if you earn $80,001, it's taxed in this range. So your marginal rate is just 34. Sometimes you hear people talking about getting moved into a different tax bracket. This is what they're talking about. All right, now we're on to cash flow. Cash is king. Also, you may have heard cash rules everything around me. It's important to distinguish between inflows, cash inflows, and cash outflows. So cash inflows are positive signs. Sometimes you see just a plus sign in front of it, or no notation is just known as it being a positive number. And then cash outflows, we'll put those in red. That's cash leaving the firm. It's denoted with a minus sign or bracket sometimes. Sometimes this, if you see a number in brackets, it just means it's negative, or it'll have negative in front of it. So just be mindful what cash is coming in and what cash is going out of the firm. Here's our cash flow identity. And sometimes you'll hear this called free cash flow. In practice, I think you hear free cash flow a lot more than you hear cash flow from assets, but your cash flow from assets can either go to cash flow to creditors or cash flow to stockholders. So just remember your balance sheet identity, that assets equals liabilities and owner's equity. Now we're just reapplying the cash flow principle, saying the cash that's being brought in is either going to the creditor or to the owner. So it has that similarity there. So free cash flow is the total cash flow to creditors and stockholders, consisting of three important elements. The first is operating cash flow, how much cash flow is coming from your operations. The second is net capital spending. So what are you investing in terms of long-term assets, buying those or selling those? And third is a change in net working capital. So I consider this like a short-term funding. So your free cash flow, or a firm's free cash flow, can come from three sources: operations, net capital spending, or a change in net working capital. Let's dissect each one of these one by one, starting with operating cash flow. So operating cash flow is cash generated from a firm's normal business activities. To do this, you take EBIT, add back depreciation, and deduct taxes. So why are we adding back depreciation if we subtracted it out before we got to EBIT? The answer is having depreciation expense lowers your taxable income. It provides what we call a tax shield. So EBIT is earnings before interest and taxes. Depreciation and amortization is added back. Depreciation is the allocation of a tangible cost over a long period of time, if that's a long-lived asset. Amortizing is something you do with an intangible long-lived asset, something like a patent. You exclude interest because interest is considered a financing expense, not an operational expense. And you deduct taxes because we do pay these in cash, and that is a part of your operations. So this is your equation for operating cash flow. You could plug that in for the component up here above. So operating cash flow itself is a subset within this entire equation here. Next, we have net capital spending. That refers to the net spending on fixed assets, which is for purchases of fixed assets less the sale of fixed assets. Think of these as manufacturing plants, property, equipment, etc. Net capital spending, to calculate this, you could take your ending net fixed assets less your beginning net fixed assets and add back depreciation. This can be a negative number. It is possible. So that's the second component within our free cash flow equation. And lastly would be change in net working capital. Recall net working capital is your current assets less your current liability. So you'd have to do this twice, once for the ending period and once for the beginning period. So you have your ending less your beginning net working capital. That will equal your change in net working capital. Sometimes I just write delta NWC for change in net working capital. Let's take a look at this example. We have Ollivander showed current assets of 1360, current liabilities of 940, and we have a balance sheet at the end of the period. So this is the ending period. The beginning period was 14. And then we have ending assets, current assets that is of 1640 and current liabilities of 1140. What is the change? So the change is always the ending minus beginning. So we don't have those yet. So we just have to take the ending one. Let's calculate ending. That's your 2015 current assets less your current liabilities. That comes out to 500 for ending. And then your beginning net working capital was your current assets of 1360 and current liabilities of 940. That will equal 420. So you take ending net working capital less beginning net working capital, that's 500 minus 420. Your net working capital change, therefore, is 80. That's an increase. Increasing net working capital, imagine that's something like inventories. You built more in inventories. That's equivalent to a cash outflow leaving the firm. So that's why you'd see in this equation, you're deducting a change in net working capital. So we had a positive 80. That's going to reduce cash flow from assets. It's going to reduce free cash flow. Just imagine you spent a lot of cash to build up inventory or something like that. Let's take a look at another example and see how we do. At the beginning of the year, the leaky cauldron had current assets of 121,306 and current liabilities of 124,509. At the end of the year, the current assets were 122,418 and the current liabilities were 103,718. What is the change in net working capital? Take a second to see if you know how to outline this. Well, this is very similar to the one we just calculated. I'm going to do net working capital at the end of the period first, and the net working capital at the end of the period is your current assets at the end of the period minus the current liabilities at the end of the period. So net working capital end is just going to be 122,418 current assets less current liabilities of 103,718. So we'll just do 122,418 less 103,718. That's your ending net working capital. So just do NWC subscript end. That's 18,700. I'm going to need that number, so I'm going to store it. I'm going to go ahead and press store 1. At the beginning of the year, Leaky Cauldron had these current assets. So I'll do net working capital at the begin. That's still current assets less current liability. So I'm going to go straight in and do $121,306 less current liabilities of 124,509. So our beginning net working capital is $121,306 less $124,509 for a negative. It is possible for this to be negative $3,203. So now we need to be careful with our change in net working capital, which is just a change is always ending minus beginning. So we'll take net working capital at the end minus net working capital at the beginning. So our change in net working capital is just 18,700 less a negative. Two wrongs make a right there. So subtracting a negative would be positive. Two wrongs don't actually make a right. That was just a joke. All right, so then we're just going to make this positive and then add it to the 18,700. Could have just added recall 1, but we'll do this. The change in net working capital is a positive $21,903. So again, if the firm is investing in their net working capital, the example I like to think about is they're just building inventory and they keep building inventory. They're not having sales of that inventory yet. They're just stacking more and more product in a warehouse. That's equivalent to a cash outflow from a firm. See, we're going to end up deducting that number from cash flow from assets, which is also called free cash flow. I loved studying these when I was a student. I figured that it's a ripe area for exam questions, and it was a good summary of what I had just been reading in a textbook. I would study these kind of things on a little flashcard until I got them down pat. They're great little summaries. They're a lot packed in here because each of these have subsets. If you notice, operating cash flow, that's this equation here. Net capital spending. But I figured if I spent a lot of time studying things like this, it would eventually make sense. It does take a lot of time, though. I won't promise that this is easy. This is finance. It's not an intuitive subject. It does take hard work and grit. But the more you work on it, I promise the better you will get at it. That's what I liked about it. Let's take a look at the statement of cash flows. That's our last element here on our learning outcome statements. The statement of cash flow summarizes a firm's sources and uses of cash. So sources, those would be positive, and uses would be cash outflow negative over a specific period. Sources of cash, those are activities that generate cash flow, generate inflows. Examples would be an increase in accounts payable, increase in common stock, increase in retained earnings. Uses of cash, on the other hand, are activities that involve spending cash. That's an increase in accounts receivable, increase in inventory, decrease in notes payable, and decrease in long-term debt. We organize the statement of cash flows into 3 units here and 3 sections. The first is operating activities. That's your normal day-to-day things. Investing activities, those are things like buying and selling long-term assets. And then financing, that relates to the right-hand side of the balance sheet, cash flows to creditors or equity. Let's take a look at this example. We have cash at the beginning of the year, which you could find on your balance sheet, all the way down to cash at the end of the year. This covers an entire statement. So it's not, you don't see 2 columns like you did in the balance sheet. This covers an entire period because it goes from the beginning of the year cash all the way down to the end of the year cash. So the change in cash is represented by this figure. It went up 14, and now we're just organizing it into 3 different sections. Your first is your operating activity. Your next is your investment activity. And your third is your financing activity. So your operations is what your business does. We're going to start with the bottom line on your income statement. This is called the indirect method of calculating the operating activity. You add back depreciation because depreciation reduced your net income, but depreciation itself is a non-cash expense. So we need to add that back. An increase in accounts payable, that's a source of funding. It means you got cash that way because you had assumed all of your cost of goods sold was cash, but in fact, you didn't pay cash for all your cost of goods sold because on your balance sheet, you have accounts payable. That means you have some product that you bought on credit. You didn't pay cash for it. So that's a short-term source of funding. You have to deduct an increase in accounts receivable. Again, when you calculated net income, you were assuming at first that this is all cash, but some of the sales happened on credit. Your customer didn't give you cash for it. So if accounts receivable goes up, that's a reduction in cash because you initially are assuming starting with net income that it's cash, but you got it on credit, so you haven't been paid yet for it. So you have to subtract that out. An increase in inventory, we talked about this one a little bit, but if inventory goes up, you're spending cash to do that. And then be careful with your financing activity, similar to what we did. A financing activity, if you're decreasing a liability that costs cash to do that, you had to pay cash to do that. Same with long-term debt, that's an outflow. If you pay a dividend, that's cash flow leaving the firm. in an increase in common stock, that is a positive. An owner has given you money. So thanks a lot for this. This is a statement of cash flow from Apple from years ago. I loved looking at these, just loved learning from a textbook, but then always wanted to roll my sleeves up and see what it looks like in the real world. So I hope you enjoyed this unit. Thanks a lot for joining me. Take care, everybody.